Hello and welcome. This is the Insurance Pro Blog Podcast. This is episode 416. I am Brandon Roberts.
And I am Brantley Whitley.
And you are listening to the internet's favorite podcast about life insurance.
Yeah, and other things. But today it's actually about life insurance. So
it is.
I just wanted to throw that in there in case people were getting ready to leave. Stick
around. Yeah. It's about life insurance and not tariffs.
That is true. So what's on tap today?
We are going to talk specifically about how you will use life insurance to create retirement income, how you can live off your life insurance policy.
Totally new topic.
I mean, blazing new territory here.
I think we're going to bring up some original points, though.
We are, because we do get asked numerous times throughout the year, like, can you really do this? Do people actually do this?
Mm-hmm.
Do they buy life insurance? Do they accumulate cash? Do they realistically use it as income in retirement?
Mm-hmm.
And the answer is yes, they do. The slightly more complicated answer is that those who do it don't usually do it in the fashion that you might be thinking.
Mm-hmm. Mm-hmm.
And that's important in this discussion, because I think it helps do a couple of things. And probably the most significant thing it does is help people start to think strategically about what income in retirement actually looks like.
Yep.
Because that's the most important thing you can start to plan for.
Yeah. I would say over the years, that's sort of I don't think we've changed our focus of what we try to talk about as much as we've grown to put much more emphasis on the fact that we want people to always be thinking about income in the future.
Mm-hmm. Yeah, I'll give you evidence that it hasn't changed, because you can go all the way back to 2012, 11. There's a YouTube video that speaks to the fact that income is the thing.
Right.
And very few advisors are equipped with the skills to address it.
Right. But the more we've worked with clients over the last however many years, decade plus, the more we have talked about this openly, because we see people struggle with this.
Yep.
Not in practice necessarily, but in theory, they're having a hard time. They're staring down the barrel of retirement, or at least they feel like they are. And they're going, okay, I've accumulated some wealth here. I've got some money. I've got some money in a 401k. I've got some money in an IRA. I've got some other savings, whether that be brokerage accounts, or I've got a real estate portfolio, whatever. But when I retire, I don't have a paycheck anymore. So how do I take this pot of money and use it to pay the bills, so to speak? I'm oversimplifying, but that's essentially the question in everyone's mind.
Mm-hmm. I think for a lot of people,
and it's the right question, by the way.
Yes, it is. It is. And it really comes down to that's the question. The answer that they really want is, how do I do that?
Yeah.
And that's way oversimplified, but it really looks like, look, I have $2 million in my 401k.
Right.
Which is cool. I feel a little rich because I got $2 million. Is $2 million a lot of money? It depends on who you ask. But $2 million.
If you need to spend $200,000 a year, no, it's not. If you only need $20,000, it's a whole different discussion.
Probably gonna be okay. $2 million doesn't really mean anything. We have to know specifically what we're going to do.
Right.
And the kind of default answer is, we're just going to sell some assets to have income, which could work. It could, but it's very enigmatic.
Mm-hmm.
And
I mean, perfect example.
Mm-hmm.
Going through the $2 million 401k example in the present with the market volatility as it currently is, A lot of people that are holding on tightly to their chairs.
Yep.
Because they're going, well, if they were relying at least mentally on the 4% rule model of retirement, meaning you're going to sell assets every year to more than 4%. Do I go off the balance of the 4% at the end of December or in mid-March? Because those are vastly different numbers.
Yep.
So I'm just using that as an illustration of the sort of calculus.
And if you ask
required.
5 different advisors, you get 6 different answers.
At least.
So yeah, it's tough. The I'm just going to sell assets idea, it's a little too much hope and pray strategy.
Yeah.
And that unsettles a number of people.
Yep.
So having something that is more...
Do I sell it today? Because I don't need the money like tomorrow.
Right.
Or do I wait a few weeks? Because I will need it like in mid-April.
Mm-hmm.
But will the market be up or down then? I don't know. I mean, you get what I'm saying. Like you just get into all these. These are the sorts of discussions we have with people. So,
yep.
In terms of what they're thinking.
And think about being held hostage in that fashion.
Yeah.
Like, I need X amount of dollars, and I know I'm going to need X amount of dollars for the next 3 months.
Mm-hmm.
But based on what's going on with the market right now, should I take all the money now? Should I take as little money now as possible and more later? Like, when's the right time to sell? That's a very difficult situation to be in retirement.
Yeah.
And
there is no good answer. Like,
nope.
There's no right answer to that question.
And it's all driven by the fact that market assets fluctuate in value.
Yeah.
If all of this could be an interest-bearing account with a really good interest rate that I could just withdraw from and let interest accumulate, that would be such a great thing.
Yeah.
It would alleviate a whole lot of headache and apprehension and nervousness. It would all go away. And the good thing is, life insurance works that way. It does not care about changes in market conditions because it doesn't fluctuate in that fashion.
Right.
So,
unless you have a variable policy, but that's
there's that. There is that. But this is the non-variable life insurance podcast.
We should rename it.
Yes, we should.
That makes it even longer and more obscure.
Yes. Hey. We need a name so long it needs a nickname. That would be
That's right.
That would be helpful. So the one problem though that I see with the projection or the idea of life insurance as an income asset is the fact that the documents, the ledgers that are generated to help people understand, in air quotes, the functionality of the policy.
Mm-hmm.
When they show income, they always tend to show it coming out of the policy almost like it's an annuity.
Static.
Yep. And I'm not saying that you can't do that with a whole life insurance policy or an index universal life insurance policy.
Mm-hmm.
But what I'm going to tell you from experience is that very, very, very few people who use their policy for retirement income do it that way.
Right.
And that may sound strange, and you may be wondering why that would be the case. And the simple answer is because your ability to generate income is one thing that happens mostly independently of your need for income.
Right.
What I mean by that is, if you have assets in an IRA, for example, and those assets produce distributions like dividends, the dividends that get created by those assets are not necessarily immediately income recognizable to you.
Right.
Which means you may not use them as income in the sense that you're going out and buying stuff in retirement for them. You may leave them in the IRA. You may buy more of whatever asset you want to with them. The same is basically true of a life insurance policy, whole life or index universal life insurance, which is to say that the growth in cash value exists, but you don't necessarily have to take all of it out.
Right.
And in general, you won't unless you have to. because people don't tend to create more income than they need because it doesn't make sense to.
Right. Because there's always a risk that you're cutting the tail off of your income stream.
Mm-hmm.
So everyone should have that sort of eye towards, I want this income to last as long as it can.
Mm-hmm.
So if I could take $80,000, but I only take 60 because I don't need 80 right now, then you're extending the life of the income stream.
Yep. It's common that we'll get asked when we present life insurance to people. Actually, it's not common that much now because we don't do as much in the way of income projections inside the ledgers.
Yeah.
That's a habit that I've kind of gotten away from, to just say, look, whatever cash value is at the time we start income, we take a percentage of that. That's a pretty good number to work off. But back in the lazier days, we would let the software do that projection for us.
Mm-hmm.
And there were a number of people, not everybody, but a number of people who would ask the question, well, okay, it shows me that if we do this, I'll have income capabilities of, say, $55,000 a year.
Mm-hmm.
But what if I don't need $55,000 a year? And I would tell them, well, then you don't take $55,000 and you'll just end up with more money in cash value.
Right.
Which I have a certain way of unintentionally saying things as if I'm being wildly sarcastic. And sometimes I am, but sometimes I don't mean it to necessarily come off that way. And I didn't used to be able to hear the eye rolls over the phone back then. But I do think people kind of didn't realize the sincerity and the implication of what I was saying.
Right.
Because they thought I was just trying to be a smartass. But really, what I was telling them was, oh, happy day if it can generate more income than you need. Because that's just going to make everything work out better.
Right. There may be some year in the future that you need more than $55,000.
Mm-hmm.
And now you have you've increased the likelihood that you will be able to do that at a later date.
This is true. You might even call that dynamic income.
Ooh. Yep.
Subject we might have touched on a month or so ago. So the thing that we see happening is people distribute money from life insurance policies, but they don't do it as a static number.
Right.
Because the truth is, once you're retired, the number of static expenses that you generally have is not that many.
Right.
And you may have a seemingly lofty income goal. Like we have kind of joked in the past that it seems to be the case. Everybody's shooting for $10,000 a month these days.
Right.
And that's fine. But looking at those people in their financial lives, $10,000 is not these are my bills every month.
Sure.
My bills are more like $2,500.
Yep.
I'm just accustomed to living on $10,000 a month.
Exactly. I was going to say, in many cases, we have seen that in terms of the basic expenses, Social Security takes care of the vast majority of it for a lot of people.
Mm-hmm.
Not everyone, but
nope,
the majority.
So when you have a certain amount of discretion, what you'll find is that, yeah, all right, I mean, I could spend, let's say, $10,000 a month, but I'm not necessarily always going to spend $10,000 a month.
Right.
And so what we see unfolding with life insurance policies is in the months that they spend $10,000, they may withdraw $10,000.
Yep.
But in the months that they only spend $7,000, they only withdraw $7,000. They don't withdraw the full 10 and take the extra 3 and put it in the bank.
No.
That just doesn't happen.
And if they do, they probably shouldn't.
Right.
I wouldn't recommend that.
Well, I mean, in general, the rate of return on a whole life policy is better than what you would get on cash in the bank.
Right.
So why would you take it out of the whole life policy and earn a lower rate of return on it?
Which is then taxable.
Mm-hmm. Does not make sense.
Nope.
And even if you are accustomed to a certain lifestyle, there's a chance that you'll get a little more picky,
Yeah.
a little more discerning about expenses when you are retired.
Yeah.
I have seen it happen. I can't tell you how many times.
Yep.
Even for the people who have pretty excellent capacity to generate income with assets,
Yep.
they still have a lot of mental roadblocks when it comes to spending money.
Right.
Because even though I don't necessarily think it's true in all cases, they look at it as, this is it. This has to work. And so if I do something that messes this up, I'm not going back to work.
Yeah.
So like they in their minds have shut the door
Yeah.
on working for income. And there's this scarcity mentality of kind of finite resources.
Mhm.
That is the retirement assets. So they get much more reserve
Mhm.
about making discretionary expenses. Again, even the ones who, if you look at the money and you look at the income capacity, you'd think you're already generating several $1,000s more a month than you spend. Why are you having such a hard time making a decision to spend $500?
Yep. But I will say that slight bit of anxiety, if we want to call it that, is a fair trade compared to working for most people. So
healthy anxiety. I'm not criticizing it. I'm just telling you that's the mindset that a lot of people end up in.
Yep. And it's good to be cautious.
Mm-hmm. It is.
All right. So let's talk about the functionality of it.
Okay.
How does it actually work?
So in terms of taking money out, you will contact the insurance company or the agent. It's fine either way. And tell them, I want X amount of dollars. And they will send you X amount of dollars.
Mm-hmm.
Generally via EFT within a couple of days.
Yep.
Basically the same time frame that you would expect if you were to pull up your brokerage account and say, we're going to transfer $5,000 from our IRA to our regular bank account so we can write a check and pay for something.
Yep. That can vary a bit from insurance company to insurance company and that sort of thing. But I always tell people, give yourself, don't wait until the day before you need the money.
Yeah, that's not generally a good idea.
Give yourself a week or two.
Yep. Now, the cool thing about life insurance is, again, there's not as much timing concern.
Right.
So if you decide, hey, I know that, well, actually, let me back up for a second, because there's actually a piece of advice that I think works well for a lot of people in retirement when it comes to spending. I think one of the best things you can do to kind of manage a good spending habit in retirement, and there's going to be some financial gurus who cringe at this because like this is going to go against a lot of what they think about, and I realize there's a certain personality quirk that could be a pitfall to this. But I think it would actually be a great practice for most people once retired to, if they don't already have one, go out and find some sort of rewards credit card.
Mm-hmm.
Whatever it is that you're looking for. Could be travel, could be cash back, whatever. And run as many of your expenses through that as you can.
Yep.
With the intention that you're going to pay that thing off every time the bill comes due.
Right.
What you do in that situation is, one, you're benefiting from whatever the rewards feature is. So that helps you just sort of gain something in life that's meaningful to you. But let's say that your statement is due on the 15th of the month. Well, that means that a week, maybe 2 weeks before that statement due date, you will get in touch with the insurance company and say, hey, I need whatever the dollar amount is that is my current payoff balance.
Right.
For this last billing statement. And then you get the money and you pay the statement. Really great way to manage cash and expenditures. Understanding that you can't always get all of the expenses through there. That's fine. Don't worry about that. But, you can get a lot of them through there.
Yep.
That helps simplify a lot of things. You don't necessarily want to be in the business of, oh, this bill is due on the 1st and that one's due on the 10th and that one's due on the 8th. So we're going to have to call the insurance company 3 different times.
No.
You don't want to do that.
Don't do that. They're not a bank.
No. And even if they were, you don't like, even if you're going to make withdrawals from from an IRA, you don't want to constantly go in and transfer money like that.
Right.
But okay, that was an aside. The big thing I wanted to say was, as we already discussed, the timing aspect is not a big deal here. So it's not like you got to wait till the very last minute because you're trying to get as much interest as possible.
Right.
You take money out of a life insurance policy, interest doesn't really change. So you don't have to worry about, we're going to wait till like the day before to move the money. That's not really on the table. Nor do you have to worry about, oh, well, the market's not doing so well, so maybe we hope that tomorrow's a better day before we sell.
Right.
Now, a lot of people get really, really, really hung up on whether or not they should do distributions as a withdrawal or a loan.
Yep, because you can do both.
You can.
Or either.
And I would tell you that while there are some very general rules about when to do what, even if you get it backwards, you're not going to ruin the plan.
Yeah.
The very sort of general advice when it comes to retirement income from whole life insurance is we typically withdraw bases first and then we take loans.
Right.
You don't have to, though. And it's not going to completely upend the whole life policy as a retirement vehicle.
Mm-hmm.
Index universal life insurance, we almost always use loans because the indexing loan features are quite fantastic. And there's not really a lot of compelling reason to take withdrawals. Do you understand that withdrawals from whole life insurance do result in a reduction in death benefit that is larger than dollar for dollar?
Yep. Because
you are forfeiting paid up additions in that case. So you take $10,000 of cash as a withdrawal, you're going to lose more than $10,000 of outstanding death benefit.
Right.
That is going to happen. Whereas if you take a $10,000 loan, you're going to see $10,000 net difference in your death benefit.
Right. I do want to stress too, we're talking about this in the context, the loans versus withdrawals. We're talking about it strictly in the context of you're retired and now your sole purpose for the cash value in the life insurance policy is as an income source that you have available.
Mm-hmm.
If you're not at that stage and you're just looking to take money out for short term to do something with it, then that's a different conversation.
Yeah.
Because, and I wanted to mention that because we've had this discussion with people before. With withdrawals, they're irrevocable.
Yes, they are.
You can't put that money back.
With whole life insurance, at least.
Yes, that's what I meant. Sorry.
That's okay. So yes, you withdraw, you're not putting that money back in there.
Which means you've lost some of the earning capability of that cash value. Yep. Whereas if you take a loan, the money's still earned, even if it's a direct recognition policy with some reduction in the dividend, you're still getting a dividend on loaned balances. So
Correct. So, and people may be listening to this and thinking, well, if I'm using it for retirement income, why would I ever put money back in there?
You wouldn't.
Well, there could be circumstances where you have other assets and you decide you want to de-risk, and you end up moving them into your life insurance policy by way of paying back your loan.
You're right. That's true.
And that can further augment value.
Yep.
Legacy value in the life insurance policy. A few years ago, we did a podcast specifically on that subject. And if you're really, really looking for some sort of generalized guidelines on when to take loans versus withdrawals, there's a YouTube video we've done recently that speaks to kind of the rules of when you would choose one versus the other.
Right.
But the one thing that I do want people to be aware of, again, going back to the ledgers that depict income, and kind of the main reason we've stopped showing income scenarios in those. Not that we never do it, but we have pulled back on a lot of it. There's a lot of assumptions that are being made under those scenarios where we know everything.
Yeah.
We know what the rate of return is going to be. We know how long the income is going to go for. And we don't know those things when you realistically start income on a policy that you own and you enter retirement. So we have to have some guidelines that say, all right, this is how much we think is safe to take on an annualized basis. And we may find out 10 years later, we could have taken more. Even if we knew that 10 years prior, if you didn't need the income, you wouldn't have taken it.
Right.
So it doesn't really matter though. But just know that our rules, as we talk about them in terms of what should be distributed, they're based off that largely. That we don't know necessarily how long you're going to live and what the ultimate rate of return on this thing is going to be over that time span. But we do know what has a very, very high probability of success. And that's what guides our general recommendations, which is somewhere in the 5% range neighborhood for whole life insurance and 6% for index universal life insurance.
Yep.
As a static number, which can be changed if you end up taking less or more at some point as you're taking income from these things.
Agreed.
So the real big understanding or takeaway is it's probably not going to be a static number, but the withdrawal process is just as simple as taking money from any other asset source.
Yeah.
It's a balance of value, and you can totally withdraw against it, and we can use general guidelines on what the maximum amount that you should take out is. Now, some people look at it and say, I think I only want to use it when in times of necessity.
Right.
So I'm gonna, for example, sell other assets when they're increasing in value, and I'm gonna use life insurance when the market is crashing.
Yep.
Which is fine. That does work. I still think for those people, they should probably spend some time thinking about how they will use those other assets to generate more consistent, not necessarily guaranteed, but using assets that are more conducive to income generation in general.
Right.
Versus I'm just going to sell them.
Right.
That's going to be a more winning strategy with actually less money needed, accumulated in most cases. And you can totally coordinate life insurance with that scenario to build out varying levels of stability in your income.
Yep.
And that's pretty much it.
That's all I got to say about that.
There you go. It's not any more complicated than that, but people do it. We've done it.
Yep.
And it works quite well.
It does indeed.
So, with that, I am Brandon Roberts.
And I am Brantley Whitley.
And we will see you next week.